Hey there, my investing curious friends. Welcome to Opening Bid. I'm Brian Sozzi, Yahoo Finance's executive editor. Thank you for joining us either on YouTube, Yahoo Finance, or Spotify. Now let's make some money. Joining me today is Truist Co-Chief Investment Officer and Chief Market Strategist Keith Lerner. Also here's a friend of Opening Bid, Yahoo Finance's very own Ines Ferre. We have three topics to rip apart in this episode. Number one, why your stock portfolio may not be safe. Number two, big tech companies giving away free money. Who doesn't want to hear about that? And last but not least, Elon Musk potentially being fake to his fanboys. So glad you guys can join us. And Keith, I'll go over to you. How do you get two titles? I mean, how do you get a Chief Market Strategist and Co-Chief Investment Officer? I mean, I need two titles.
Yeah.
And Ed needs two.
I guess I'm special. You know, I mean, it's taken a long time, but you know, I've been in this business for 25 years, so I think I've earned it now.
Well, you still look 25, Keith. All right. Well, always good to see you here, and I love your notes. I love when you put them out. I love all the hustle you put into your research. It is some of the best on the street.
Can you say that again?
I will get to it. But this quote you wrote in your most recent note really left an impression with me. Pullbacks are the admission price to the stock market. Talk to us about that.
Yes. Well, you know, when I think about the stock market, it's over the long term, we all know that it's generated powerful returns. But the admission prices are those periodic pullbacks. And what we mentioned in our recent note was that since 2009, we've had 28 pullbacks. You talked about these or written about these 28 pullbacks. Every one of them.
Every single one.
Every single one. I always say that every pullback comes with something. It's called bad news, right? And you know, it's hard. It's hard to stay on that path. But over time, the market has rewarded discipline. But it can be scary at times. And even more recently, you know, it's like we had this 5-month straight up of this market, and then you're down 5%, and it feels like we're down 15 or 20% as well. And you have to just live with it. Is the bottom line. It also can create opportunities when you have some of these scary points in the market.
But it's hard to pick the bottom for an entry point. So how do you pick the bottom?
Well, you don't need to. I mean, if you think about
That's no fun.
Yeah.
We try to have better entry points for new cash. But think about this. Up until a few weeks ago, every person that had been invested in the stock market at any level was money good because the market was at an all-time high, right? And I know after inflation and this time and so forth, but I think the main thing that we try to do, we always talk about the way of the evidence. And you know, after that first quarter, we do a lot of historical studies and say, hey, how does the market act after you've been up 5 straight months? How does the market tend to act after you have a 10% first quarter? Most of those trends say, when you look at 6 to 12 months, the market, the probability of being higher is good. But the big but we said coming into this quarter is the minimum pullback that we've seen after those strong first quarters for the rest of the year is 4%. The average is closer to 7 or 8%. So again, that's going back to your question about the admission to the price market, to the stock market of these pullbacks.
Are people? Is that one of the biggest mistakes you still see from investors, that they're trying to pick the bottom? Everybody wants to be a hero.
Yes, I mean, the way we think about it is, and more recently, as we've pulled back, we said the risk reward is improving. We're not trying to say this is the low, but we've pulled back 5%, we reset sentiment, and we think that opportunity is better for folks that have cash or is underweight their targets. But you're right, I mean, listen, even as a strategist, it's great to be able to say, we got the bottom or we got the top. Our process, what we try to do is
because I used to be an analyst. I loved making that big call. Like, oh, ooh, I just picked that stock. I'm jacked up. I want to get on financial TV.
Yeah, and listen, it's you know, you got to be careful because, I mean, what's more important, you know, trying to be cute to get the exact bottom or saying, hey, the risk reward is more improved, and don't worry to get the last 1 or 2%. Now listen, as a strategist, you have your good calls and bad calls. Actually, one of my best calls. Can I?
No, of course. Tell me.
Okay,
we're here to talk. We're here to talk.
At the October low, we wrote the note that day as the market was breaking down. There was panic saying this. You know, we think this is a buying opportunity, and we were within 1% or 2% of the low. So we hit that.
Nice call.
But then
nice
again,
call.
I remember also in 2008, which I was early in my career. You said, how do I get 2 titles? Well,
So you got to make big calls. That's
yeah,
how you get
it's
2 titles.
No one was watching anyway,
correct.
so who cared? But I actually took over as the chief strategist in late 2007, right before the global financial crisis. And by the way, you don't know what you don't know until you go through a period like that. So I will say that was a more challenging period, but it was actually, it helped me become a better analyst now. But I remember in late, I think it was early 2009. I made a call back then around 750 on the S&P saying we thought the low was in. And then we broke to like,
750?
Yeah, 750.
Now we're what, around 5,000.
Yeah,
We've
well, that's another.
we've been doing this for a
For
while.
a long time. But by the way, going back to that stat we just talked about, since that time, that low, on a total return basis, including dividends, we're up over 800% despite those 28 pullbacks.
Now,
Think about that.
You're a little bit of a permeable.
Oh, here we go.
wow,
Here we go. Those are fighting words in business
You're a
newsland.
permeable. Saz is a little of a perma-bear. But I just want to ask you about, okay, look.
Wow.
We're gonna.
Inez, you're coming in
Am
hot
I a
today.
little fierce now? We got GDP that was not great, right? It's showing a slowdown.
Yeah.
Everyone I talk to doesn't feel that inflation is really going to come back down to 2%.
Okay.
They all feel like we're going to be in a higher for longer inflationary period. So that to me spells stagflation. How do you position yourself in that kind of market? Where do you go and what kinds of equities?
Can I retort before I answer the question?
Oh, yeah.
Yes, go ahead.
I like, because I think as a strategist, you don't get credibility until you're on both sides. So I will say we were negative most of 2022, and actually we overstayed our welcome on the negative side as well, and then we pivoted in 2023 as the data changed. So I just want to put that out there.
Inez, you got
I want to.
actually, for the record,
Yeah.
before you answer that,
Yeah.
I'm not a perma bear. I'm just reporting.
He
numbers.
calls me up and he sends me a message saying, "Hey Keith, are we going to talk about Dow 1000 today?" So I don't know how you say Sozzi.
Listen, I should have said off the record for that one. Keith.
Okay, sorry.
All right, go.
But let me ask you a question. First of all, it's interesting. You get one report, and then all of a sudden, the key Google search term is the word stagflation. We're not there yet. I'm not saying it's not a risk. I'm just saying that, if you look at the GDP report yesterday, the headline was weak. The underlying components, consumers are still spending, business spending is still there. Initial jobless claims were, very low at close to 200,000 yesterday. So in my mind, if the labor market's still relatively strong, and that's going to lead to wage growth continue and spending in the economy. And then you think about, okay, let's just say that inflation is a little bit high. Well, if you look historically, there's a high correlation between inflation and earnings. And earnings earnings help hedge some of that inflation risk as well. And if you look long term, after adjusted inflation returns, the equity market is one of the better places to be. By the way, I had Professor Siegel, stocks for the long term, on a call with our advisors recently, and that's something that people forget. Like that is as you have inflation, that means sales are moving higher. That means earnings are moving higher as well. So it does compress valuations. So I don't want to be just a perma bull. That will compress how high valuations will go. But I don't think our view at this point is not that stagflation is the base case.
And we should quickly define perma bull is usually seen as what? Someone always bullish on stocks, right?
Always like Sozzi.
Look,
Not like Lerner, like Sozzi.
let me tie a button on this one before we hit our
Okay.
next topic, Keith. Near term,
Yep.
our investor portfolios safe? A lot of folks that come on Yahoo Finance, they're overweighted a lot of tech stocks, a lot of volatility. But to Inez's point, incoming information on the economy is starting to change. What does that mean for stocks near term?
Yeah, by the way, I guess I didn't answer your question about how to invest in the environment. So we still think, the way we think about it, we would be, I guess, modestly overweight equities still.
A little more upbeat.
Yes, but we're not. By the way, we're also not saying where valuations are and some of the geopolitical risks. We're not saying this is time to max bull phase either.
Gotcha.
But overweight equities, still sticking with large caps. Still, we've moved more towards a mix of the growth stocks. And unlike last year, we've also earlier this year we have overweights to financials, industrials. Energy had a big move as it pulled back over the last few weeks. We've actually upgraded that as well. So you're talking about inflation. Well, energy is an inflation hedge. Mm-hmm. By the way, the industrial area, there's a huge amount of distribution of those stimulus checks that are just stimulus that's still being distributed now as well. So I think those are some decent hedges.
All right.
And don't forget about bonds either. Bonds.
Well, that's not fun. Nobody wants to talk about
Okay,
bonds. I mean,
fine.
that's just boring.
My
I
fixed
don't want to
income-
put people to sleep here. Come
My
on,
friend
Keith,
Chip
this
Huey, my
episode
fixed income head. I never said that bonds were boring. Just
All right,
for the
just
record.
go. It's okay. Get it out there. All right, next, topic 2, which I think falls into volatility in the market.
Yeah.
Why are big cap tech companies giving away free money? Now, this is just a clever way of saying the likes of Meta in February came out with their first ever dividend at 50 cents a share. Alphabet, when they reported earnings, first ever dividend that they will be paying 20 cents a share. How important are dividends? Well, first of all, let me ask this. is it surprising that big cap tech companies are finally paying dividends?
Yeah, maybe, but I think part of it is they can. They don't need to. I don't think it's good. I mean, maybe there's a new investor class that comes in on the margin on this, but they have huge cash balance sheets right now. So I think they're just saying, hey, this also shows some fiscal discipline, because once you start paying that dividend, you need to continue. And by the way, I mean, they have so much cash, they're only giving away a little bit of that cash as a whole. So maybe they just want another investor base, maybe a more stable investor base.
Yeah, Alphabet, what, 20 cents a share dividend? I'd pick it up. I had 20 cents. They could do better than that.
I mean, it's like I said, it's a marginal thing, but I don't think people are investing in those names specifically for the dividend. They're still investing based on the growth. What's amazing is we got these trillion-dollar companies. You look at the earnings that came out recently from Microsoft and Alphabet, and they're growing the top line at 16, 17%.
It's abnormal.
And going back to
is that inflationary? I mean, you're seeing it in those top line results.
Yeah. Well, if nominal GDP is closer to 5, they're doing triple. But don't forget, these are global titans, not just the U.S. as well. And I mean, there's concentration risk there because, you know, they're the ones who are building the databases for AI, and it takes a lot of money as well. So I don't know that's inflationary. I think the tools they're developing hopefully will be somewhat deflationary over time, but the buildup in spending is huge.
Is it as a strategist, Keith, when you see these companies that have grown at these mind-blowing rates for years, paying out dividends like boring companies, dare I say like Berkshire Hathaway, is that a red flag that growth is going to slow down?
I don't think it's necessarily a red flag. I think almost by definition, I mean, as you continue to get to like how big these companies are, the growth rates have to slow down somewhat. But you even look at within these companies, like yesterday on Microsoft on their cloud business, I mean, growing 30%. So I think what you'll see is within the businesses, you'll have the old kind of cash flow rich part of their business growing more like nominal GDP, and these other areas, growth areas, doing somewhat better.
Should investors be concerned? I mean, when Meta came out with their results and the amount of spending that they're doing on AI, should that be an area of concern with how much companies are spending on AI? Or is this even more, as you say, it would be deflationary later because you're spending on AI and that'll be more efficient, productive? Yeah,
well, I think there's a risk because we don't know, like, the end game is how are these companies going to be profitable? So what you saw in the market after that announcement, and by the way, this is after the year of efficiency. People got very bullish on Meta because of the year of efficiency. The question becomes, okay, what does this mean? But then you saw the picks and shovels actually do well, right? Because they're going to be spending more. So you saw the NVIDIAs and the semiconductor group actually really, really strong after that announcement. So I think it's going to be more winners and losers. And the question becomes, at what point do we move from the picks and shovels to the companies that amplify the use of AI? And the example that I always use is going back to the late 90s. You had Cisco Systems being the picks and shovels, and then you had Amazon, you know, really amplifying that. But no one knew it at the time exactly that they were going to be the leader.
Good point. All right, if you are watching us on streaming platforms, we're heading for a quick break. Everyone else stay with us. We are still rocking our 24 minutes today as usual. So we're really diving into the world of dividends. You know, looking forward, Keith, what should investors place more stock in? Companies growing their earnings fast, or is it better to just focus on companies paying these dividends, even though they may not be growing at the pace they were?
I think it's more of a total return aspect. I would say, look at it historically, just buying something with the highest dividend is typically not the best strategy. Having a company that has good growth and has a growing dividend tends to be somewhat better. And like I said, an inflation hedge. The other thing with dividend stocks today, they've underperformed. If you think about the traditional areas like utilities, staples.
Who wants to own those? I mean, can you imagine just reading? I tried to read. I do read utility earnings. I mean, what a snoozer! You really don't understand what these companies are even doing.
Yeah,
it's so boring.
Well, you know, you say that there's a narrative going around, whether we believe it or not, is that because of all the massive use of energy, like that utilities. Stodgy utilities.
Oh yeah, well you cover energy.
Maybe
100%.
AI player.
You're a perma-bull on energy, right?
I am
perma-bull on energy.
Always positive.
Yeah, because you're going to need a lot more of it, and data centers are going to need more of it. You're going to need natural gas to produce more electricity. So yeah,
But they're regulated too, though, right?
They are regulated, but it's an interesting space to be covering. But you know, back to your point, Soz. I mean, is this creating a new class of growth stocks, the ones that also offer a dividend? I mean, is this going to bring in a new type of investor?
Well, I personally, I believe a lot of these companies like Google or Alphabet and Meta are issuing these dividends and buying back billions of what these companies are buying back in stock. Alphabet in the most recent quarter, they enacted a $70 billion buyback, huge buyback. Meta repurchased, they enacted a $50 billion buyback in the first quarter earlier this year, bought back about $14.5 billion in the first quarter. I mean, these are big numbers. I think they're doing this because growth is going to slow sharply in the back half of the year next year because of the billions of dollars they're spending on CapEx to support AI rollouts.
Yeah, listen, I do think they know that stage is coming. They're going to transition as a whole. But again, I mean, think about the massive amount of buybacks relative to these smaller dividend payments. I just think they're probably sitting around the table like this and saying, we got all this cash. How about we buy back some stock? How about we do something? Yeah.
I hate buybacks. I have railed on this repeatedly on my LinkedIn page, on Twitter, you name it. I just think it's just an artificial way to boost net profits. It's just mathematics.
You know, at the end of the day, you think about those. Some of these companies, that might be true, but if you think about, when Buffett talked about buying Apple a long time ago, he was saying every year he becomes a greatest shareholder of that company by doing nothing because they're buying back the stock. So
it's hard to argue.
I mean, if you want to go against him, he's 93, but
he knows.
He's got a pretty good track record.
Well,
Mr. Sozzi.
Let's stay on. We're really going to test your two titles here, Keith, with this last topic, and that is Elon Musk potentially not directing his fanboys in the right way. I put out a tweet earlier in the week going back, and this was a good chart from Bernstein analyst Tony Saganaki, looking back to 2016, all of Musk's comments on full self-driving, and it really went viral. I think it's approaching 150,000 views, so hat tip to me for putting it out there, and hat tip for really Tony for giving me all this free research. But I go back to 2016, October, Tony says this, points out, this comes from Musk, Keith, quote, Tesla expects to demonstrate self-driven cross-country trip next year. This has never happened. and Tony lays out all of these times that Musk has said this on investor days, earnings calls, various conferences, there is no self-driving. How important is AI to a story like a Tesla at this point?
Number one, I would say I would need a third title of equity fundamental analyst to give you a great
answer. You
can
do it all.
But I'm gonna
That's
try.
why you're here.
Listen, I think with some of these companies and some of these leaders, it is about the story, and part of the story is the AI side as well. So, as you talk to people that are fundamental analysts and following the Tesla story, it's not about the cars; it's about the technology and the AI.
So they view a Tesla as a tech play.
Yes, yeah. I mean, they're not looking at a low margin car business. They're looking at they're going to change the way autonomous vehicles. And by the way, I mean, talk about someone who has multiple titles. I mean, how many on that as well?
So I'll put you in the Elon Musk class. You're right there.
Thank you so much. I can go with that.
Well, it is. You cover, like we mentioned, you're covering energy. It is amazing just to see this pivot now to full self-driving. For the past 2 years, Musk has been talking about lower cost cars, and now, boom, August 8th, he's going to unveil a robo-taxi. And this is a real fundamental shift in the investing thesis for a company like this.
Are you going to take the first taxi drive with?
Oh, I would definitely do it.
But, stop.
But I think that, look, Tesla to some investors is very much a data company, and it is about software, and it's about FSD licensing it to other automakers, and it's even pushing more. It's even pushing away from just manufacturing the actual vehicle, but it is really about the data. It's about the software. What I found also very interesting about the last call and the previous one as well, energy storage. That is, talk about energy.
What, Solar City or?
With their megapacks, it is for utilities, it's for commercial use, it's for storing energy to be able to stabilize grids. I mean, that's growing. That, in fact, Musk said that that's actually growing at a faster pace than their auto sales, even though it's a smaller piece of the pie. But it's interesting. I mean, they are really expanding into a lot more than just the vehicle that is an electric vehicle. And so with FSD, I think that that's also part of the narrative of
like a licensing. You know what I would suggest is maybe we have Mr. Musk come on.
Well, Elon is more than welcome to come on. I mean, he's going to watch us on X. You can come. You can hop into the conversation, Keith. But look, how should an investor view Tesla? Here we have a company, of course, putting out earnings and sales like a normal public company. But we have this figure in Elon with the tweets. things he says on these earnings calls that we don't hear from other leaders. How does an investor even approach investing in a company like this?
I think you got to go back to some of what you talked about with the opportunity. Like, what's the projections? What's the earnings? And honestly, it's part of hope that you have. I think when you invest these people, you say, hey, they've done this over time. You're betting on that person being able to deliver. Because when you look at traditional metrics on these companies, like, to say what price is a fair value for them, I mean, it's a total guess. I mean, there's no justification. By the way, you think about Amazon, I talked about that being a poster child of the technology era. That was down 90% at one point, and then it came back, and obviously we know the story, but it traded at a high multiple forever. So I think it's one of the ones is you have to have faith and hope and hope that he delivers, and that's what you're betting on.
I will note this, unrelated to any of the thing in this conversation. Opening bid is shot, in fact, in front of a live audience, and that is the Yahoo Finance newsroom. And I see everybody coming from the kitchen with their amazing bagels. Like, I need a bagel, Keith, since you came here and we're not paying you to do this. You can get a bagel too.
I'm a low carb guy. I'm trying to be.
Really low carb guy? You've looked the same for the past 10 years.
That's why, because he's a low carb guy.
I came yesterday off the plane in New York City. The first thing I grabbed is like a big sandwich.
You start hustling after all
these years. And then I had a
years.
salad last night.
Well,
that was good.
So we got a couple minutes left, and I try to leave folks, listeners or viewers of Opening Bid, with two things. And I think in your case, you can do this. Your biggest final call for the rest of this year.
My biggest final, wow, that's okay. I can try to do this. Well, I think ultimately we think the overall market moves higher still, right? I think again, we're in a
Purple.
I think we still move higher in the year. I mean, I think, if it's kind of boring. We still like the U.S. We still like tech, but you asked me for one. I like the combination of like what I mentioned before, tech along with the cyclicals like industrials and energy and financials together. I think that's a good overall package. And if we have these rotational markets that we have, I think that will create a smoother ride for investors.
And the biggest investing tip for the average investor?
I think that this is simple. Let the market work for you over time, right? I mean, we show this. We have this deck that we show, and it shows the probability of success in the equity markets. In any given year, maybe the market's up 60 or 70% of the time. Over 5 years, up 85% of the time. Over 10 years, up 95% of the time. Over 20 years, historically, up 100% of the time. So I think we all have tickeritis. It's interesting, but I think having an anchor on like what is the purpose of that money, and on the equity market, let it work for you. And then we're going to try to do things to, take advantage of opportunities on pullbacks and mitigate the risk. But let the market work for you. These are companies. These are companies. And I think the one thing, even with all the stuff in the political side that people get offside on, is that companies adjust and they adapt, and that's one thing in my career that I've really learned in this business. Have faith in our corporations. They adjust, and I mean, it's a great profit engine over time.
Well, I'm feeling really inspired. I'm ready to go get my bagel and run through a wall, and we're gonna wrap this one up. And well, we got a couple minutes left. You ever wanted to ask me anything, or Ines? And we're always asking you questions. You go constantly on Yahoo Finance. Hit us. We got 30 seconds.
Okay. Well, I just don't understand. Like, I was talking to you coming in, and you said you get up at like 2 o'clock or 3 o'clock.
Yeah, this is actually.
That's a mystery around the entire newsroom.
Yeah, I'll lift the veil a little bit. I do get up at 2:35 a.m. I take the
2:35, not 2:30.
I take the 3:10 train, and usually I'm at my desk by 4:25 a.m. If everything goes okay, I study markets. I talk to, I send Ines some Slack messages, and that's how we make the money here at Yahoo Finance.
And I get messages from him at like 5 o'clock, but I respond.
Yeah.
In my office, they think I'm early because I get up at 4. Now you got me beat 2:35.
Well, that means you have to get up earlier now, Keith. After you send this around your whole entire office at
Listen,
Truist.
I'm 2:30, 2:34.
Yeah.
That's my new wake up
All
time.
right, guys. Well, Keith, I really appreciate it. Keith Lerner over at Truist. Always appreciate your time. Ines, Ferre, I'll see you back in the newsroom.
Thank you.
All right, that's it for the latest Opening Bid.